Hi, this is Steve from cimabtc.com. So we are going to look at the money market hedge again under the foreign exchange rate risk hedging techniques, external hedge techniques. So what do I mean by money market hedge? So firstly, is that the aim of the money market hedge is that we are going to pay somebody not in foreign currency, but rather we're going to pay for them using our home currency. We're going to receive the money from the foreign customer, not in their currency, but rather in our home currency. So this is the aim of our money market hedge. Okay, we are going to pay something and receive something in our home currency. But how are we going to do that? We're going to do that using the money market. So what do I mean by money market? It's something to do with our money, which is the cash balances. Either we're going to deposit money or we're going to borrow money from the bank. So nothing more. Okay. So by doing so, we can lock that foreign exchange rate into today, because we're going to use the spot rate to convert those foreign currency into our home currency. Okay, so yeah, this is the idea behind the money market hedge, and how are we going to try to use a very standardized approach to try to deal with any of these money market hedge questions. So I'm going to show you a table here, okay? So let's have a look at two circumstances. So the first circumstance we're going to look at is the money market hedge with regards to the receipt. So I told you in the earlier section that we're going to receive our money in our home currency. So this is the aim of the money market hedge. So what we're going to do is that we're going to set up a table here. Foreign market, home market in your home currency, now and future. Okay. So the first step is that you're going to receive the foreign currency, which is dollars, at some point in the future. So you want to receive it, receive the amount of money in your home currency. But how are you going to do that? Of course, you're going to first step is that you're going to create a liability, which is borrowing some money from the bank, because you're receiving some money from the other customer, which is an asset to you. So you're going to create a liability to set off against each other. So you can see here, by doing so, you can eliminate all of the dollars here. You're not going to receive any dollars at some point in the future. So that's the reasons why you're going to do that. Okay, so you're going to hedge against it. But the next question is, you can see here, next question is, since you're going to borrow some money from the foreign bank, fine, that will be no problem. You're going to borrow that from the foreign bank. And once you've got those dollars, what are you going to do? What do you think? Well, you borrow a lot of money from the US bank. Fine, you've got the dollars in hand. Is that useful to you in your home market? The answer is no, because you need to pay for something in your home currency, which is in UK pounds. So what you're going to do is that instead of holding too much money on hand, what I'm going to do is to try to sell to our home market bank. So we're going to sell that dollars to get the pounds. Okay? So once we've got those pounds today, what I'm going to do is that, well, I said to you in the earlier section, is that we need to consider the time value of money. The money will be inflated up and up and up again. So what we're going to do is to try to deposit them into the bank, so that we can not only receive the principal amount of money, which is in UK pounds at some point in the future, but rather, of course, we can also receive the interest expenses from the bank, interest income from the bank. Yeah, at some point in the future. So that's the reason why we need to deposit it. So in some of the circumstances, of course, you can argue that you're going to invest in some of the positive NPV projects. It's up to you really. But in the exam, to simplify this idea, we're going to deposit them into the bank. So you may not think about this. You cannot think about this maybe in your exam. So my approach here is that, firstly, you're going to create a liability to set off against the future currency. Fine. Secondly, you need to establish your aim. Your aim is to try to, because this money market hedge receipt, your aim is trying to receive the UK pounds, okay, in your home market. How are you going to do that? Of course, you're going to either deposit money or borrow money. If you're going to deposit the money, of course, you're going to receive money in UK pounds. If you're going to borrow some money from the bank, of course, you're going to pay something, okay, in your home currency. So here, in this case, we're going to, your aim is to try to receive pounds, okay, so that's the reasons why you're going to do that. So, yeah, that's it, and, you're going to borrow some money from the bank, sell the dollars to get the pounds, and then deposit those pounds and try to receive in UK pounds, okay? So, once you've got the receipt at some point in the future, you can use that receipt to pay off the borrowing you make in the foreign bank, so set off against each other. Yeah, that would be fine. And then instead of receiving in dollars, you're receiving in pounds, so that is the aim of the MMH receipt. Okay, so that's it. This is the first aspect of our MMH. The second one is something to do with our payment. So always, the table will be always the same. So we've got the foreign market, home market, now and future. Okay, so you're going to start from the future first because you need to pay in the foreign currency. Fine. So what you're going to do is that you're going to deposit your money, deposit the dollars. You can see here the dollars will be the same because it will be in the foreign market here. By doing so, you can eliminate any of this foreign exchange rate risk. Because once you have to pay to the supplier at some point in the future, you're going to use that deposit denominated in dollars to pay off against those dollars. And by doing so, you can have no foreign exchange rate risk anymore. But the question is, how are you going to get the dollars in order to deposit it, okay, into the foreign bank? Of course, you need to purchase, you need to buy the dollars in order for you to have enough dollars to be deposited into the foreign bank, okay? So that's the reasons why we need to buy dollars over here, okay? Because our aim is to try to pay in pounds, okay? Trying to pay in pounds. Either we're going to deposit money to receive pounds, or we're going to borrow some money from our home market so that at some point in the future, isn't it? At some point in the future, we need to pay back to the bank denominated in UK pounds. So that's the reasons why we're going to borrow the pounds over here. Okay, so let me just remind you is that after we have to pay at some point in the future, we can use the deposit to set off against each other, so we have no forex change rate risk anymore. Because it's the MMH payments, because we have purchased it, we purchased the pound, we purchased the dollars in order to, deposit it, so that we're going to borrow some money from the bank, okay, denominated in UK pounds. You may have a question, oh Steve, do we need to borrow money from the UK bank to pay the interest payments and also use those money to deposit it? Of course, maybe the answer is no, because maybe you have lots of cash within your company. Of course, you can use those cash surplus to do that. But for the sake of argument in the exam, create this table, okay, because it is your exam, from your exam's perspective, just to simplify this idea, so that you're going to borrow some money from the bank, from your UK bank, your home bank, so that you can purchase the dollars to be deposited into the foreign account. So that's it. And next question is, you can see here, this is now, this is future, okay, and you're going to, how much you're going to pay or receipt at some point in the future. But the question is, either you're going to borrow it at today's terms, or you're going to deposit it at today's terms. Which means that money at some point in the future may not be the same value as today's terms. What that means is, you need to discount those future payment or receipt into today's terms. So that here, we're going to use the present value. because it is relating now. Next question. You're going to sell the dollars, okay, because you borrow the money from the foreign bank in order to get those your home currency, which is the UK pound. So, and also MMH payments, you're going to buy the dollars in order to deposit your dollars into the foreign bank. Fine. The question is, are we going to use the forward rate or the spot rate? Of course, we are going to use the spot rate in these two circumstances. It is simply because it is relating to now. Okay? So, the next of our question is, we're going to see that borrow money or deposit money, which rate we should use. Either we're going to use the interest rate in our home currency or foreign currency. What do you think? Of course, because we are borrowing money and deposit money in a foreign country, so we are going to use the foreign interest rate. But what about the deposit money and borrow money in our home country? What do you think? Of course, we're going to use our home interest rate. Okay, so that's it, nothing more. And the best approach to this, to illustrate this, is to have a look at the example in your study notes. I hope this example will cause you no problem at all. So let's have a look at the first one, which is the MMH receipt. So, required is to use the money market hedge to hedge the receipt in 3 months' time of $200,000. So, the first step you need to do in the exam is to try to set up this table. So, we've got future, and the future is in 3 months' time. Okay, and on the left hand side, which is the foreign, and right hand side is the home. And you can see the question here is that you're going to hedge against the dollars, which is the foreign currency. What about the home currency? In the question we can see it's the UK pounds. Okay, so this is your step 1. And the step 2, because you're going to receive $200,000 in 3 months' time. So, next question is, because this is an asset, isn't it? You're going to receive an asset, you're going to receive the cash from the foreign customer. So you want to eliminate the foreign exchange rate risk on the left hand side. How are you going to do that? Of course, you're going to create a liability to set off against those assets. Okay? For the sake of argument, after you receive those assets, you can pay off those liability, net them off. So from that perspective, you're going to borrow the dollars from the foreign bank. Okay, but how much are you going to borrow? So in the question we said we opposed the spot rate, and also we opposed the interest rate. Okay, so interest rate in our foreign market and our home market is the annual interest rate is to be 6% to 9%, 11% to 14%. But here we are going to receive in 3 months' time, not in 1 year's time. So we can't use the annual rate, we need to adjust for that. So here we're going to borrow $200,000. Yeah, that would be no problem. We're going to borrow those amounts of money. But we need to take into account the time value of money into today's time. So what we're going to do is divide by 1 plus the rate. Which rate we should use? Of course, we're going to use the foreign rate because we're going to borrow money from the foreign bank. Fine. But 11% or 14%, what do you think? Well, we're going to see here, because we are going to receive money at some point in the future, according to the rule that you always lose, okay, compared to the bank. So from that perspective, you're going to divide by amount of figure to reflect the time value of money. You're going to divide by a higher figure to receive less. So that you're going to use the 14% rather than 11%. But because this is relating to 3 months, not a whole year, so that you're going to multiply by 3 months divided by the whole year of 12. Okay? So that it gives us a figure of $193,237. So since you have borrowed those dollars from the UK bank, from the US bank, now you don't have to use those dollars, yeah, because it's not useful in your home market because you're denominated in UK bank. So from that perspective, you're going to sell the dollars to get the pound. So how are you going to do that? Well, we are posing a question. Of course, this step we're going to use the spot rate. So here we are posing the question. The spot rate is to be dollars to pound is to be 1.496 to 1.499. Which rate we should use? Well, I'm going to tell you here because it is in dollars and it is quoted dollars to pound. So that we're going to divide by a figure to get to the pound, okay? So, but which rate we should use? Either the left hand side or the right hand side. Because here we're going to sell it to the bank. We always lose. So that we are going to sell at a lower amount of money to the bank. So from that perspective, we're going to divide by a higher amount of figure to give us a less amount of money. So we're going to take 193,237 divided by the spot rate is to be a higher figure, 1.4990, giving us 128,911 pounds. But since we've got those pounds in hand, what we're going to do is to try to deposit it into the home market. For the sake of argument, our aim is to receive the UK pounds. Okay? So how are we going to do that? Either we're going to deposit it or we're going to borrow it. Of course, we're going to deposit it because at some point in the future we can get the UK pounds from the bank rather than from the customer. Of course, we can get the money from the customer denominated in foreign currency to be set off against the borrowing money from the foreign bank. So what I'm going to do is that I'm going to take this 128,911 today, deposit it into our home bank and earn the interest. So from that perspective, because we're going to earn the interest, we're going to deposit it, earn the interest from the bank. Of course, I always lose. So from that perspective, which rate we should use? Of course, we're going to use the 6%, the lower rate. So we're going to multiply by 1 plus the 6% for 3 months over 12, giving us 130,912. This means at some point in the future we're going to get this money from the UK bank denominated in our home currency. We're going to use the money we received from the customer in dollars to set off against those amounts of money we're going to borrow from the bank. You may have a question. Well, Steve, because we borrow money from the from the US bank, that is not for free. We need to take into account the interest expenses we need to pay to the US bank. Yes, you're right. So that's why we have discounted the money using the higher rate to take into account the amount of expenses we're going to pay to the US bank. So at some point in the future, that this amount of money will grow into $20,000. So we're going to set off against each other. Next question is, you may have a question. Well, Steve, since we have borrowed the US dollars into the US bank, why not just to do what? Just to use this money to deposit into the US bank rather than convert that into our UK pounds and then deposit into our UK market. Because you can see here, if my memory serves me right, that the USA interest rate is 11%, which is higher than the 6%. Well, this is outside the scope of the P4. Yeah? Because your aim is to try to receive in UK pounds. You're going to eliminate the foreign exchange rate risk. So that's the reasons why we're going to convert, create a series transaction and try to arrive at our aim, receiving UK pounds. But if you insist in taking your money of 193,000, let me write it here, 193,233 to be deposited into the US market, that will be no problem. But if you can see here, if you're going to deposit that, which may mean that your money will grow up and up and up, and from that perspective, well, of course, you can use those gross amount of money to, the received amount of money, and also pay off the liability. That will be no problem. But it ends up with the residual dollars. How are you going to deal with that? So from that perspective, that dollars will need to suffer the foreign exchange rate risk. So that's the reasons why we are not going to use those money we borrow from the US bank to be deposited into the US market. So that's the reasons why we're not going to do that. That's the reasons why we're going to sell those dollars to get the pounds and then deposit it in our home market. For sake of argument, we're going to aim to receive the UK pound. Okay, so that's enough for the explanation. I think you are very clear about the MMH. So let's have a look at another exercise, which is the MMH payment. So MMH payment will be the same steps, okay, involved in compared to the MMH receipt. So we're going to create a table first, and then this is future, this is now, this is foreign, this is home. Okay, so let's have a look at what's what. Okay, so let's have a look at what's what. So let's look at the question. So use the money market hedge. I'm going to change it a little bit to hedge against the payment of $200,000 in 3 months' time. So because pay in dollars, of course, the dollars will be the foreign currency, isn't it? So I'm going to do is that foreign currency is in dollars, home currency is in UK pounds. Because we're going to pay, I'm going to write in that colour. So I'm going to pay at some point in the future is in 2 months. Is it 3 months? Yeah. 3 months. I'm going to pay $200,000. So from that perspective, it would be the liability from a company's perspective. So in order to eliminate the foreign exchange rate risk on the left-hand side, what you're going to do is to try to deposit to $200,000 at some point in the future. But here it is relating to now, so that you need to discount those money into today's terms to get a smaller figure, so that at some point in the future it will gross figure, okay, to $200,000. So here we're going to use the interest rate. But which interest rate we should use? Because it is relating to foreign, foreign bank. Yeah. So from that perspective, we are going to use the foreign interest rate. So here the USA is foreign. This is home. So because we're going to deposit it, so from that perspective, we are going to use the deposit rate of 11% rather than 14%. Because it's relating to 3 months, so that the deposit amount of money we're going to get is to be 194,647. Fine. So we need to deposit 194,647 today. But how are we going to get those amounts of money? Of course, we're going to buy the dollars in our home market, okay, using our UK pounds, yeah? So from that perspective, we're going to use the spot rate over here. The spot rate we are posing the question is just the same as the previous example. It's to be these two figures. And because we're going to buy the dollars, so that would be no problem. So we need to convert that into, just to use the UK pound to convert that into dollars. So how are we going to convert that into UK pounds? To reflect the money we have to pay in UK pounds to get those dollars. So because here it is in dollars, yeah, it is in dollars, and we need to get into the second currency. So that's why we need to divide by the figure so that we can get the second currency. But which figure we should use? Either left hand side or the right hand side? What do you think? Because you're going to buy it, you're going to have to pay a higher price because you always lose. Okay, from the bank's perspective. So from that perspective, well, you need to divide by a lower amount of figure so that you can pay higher. That's the reasons why we're going to use the left hand side figure of 1.4960. It's 194,647 divided by 1.4960, giving us 130,112 UK pounds. Because your aim is to try to pay something, okay? Make the payment in UK pounds. So from that perspective, you're going to borrow, okay, the money from the UK market. Okay, so in order to borrow 130,112, what you're going to do, you need to suffer the interest rate in your home market as well, because the money is not for free. So from that perspective, is that 130,112. You need to suffer the interest rate is to be 9%, because home market you're going to borrow money. Of course, you need to spend a high amount of fees, okay, compared to bank, because you always lose. So from that perspective, 9%, 3 months over 12, giving you 133 over 40. So what this actually means is, if you're going to pay for someone at some point in the future of $200,000, you can use those money you have deposited, grow up to $200,000 at some point in the future to set off against each other. But just to left you with the amount of money you need to pay back to the bank. So that's the reasons why we're going to create the MMH payments and such like this. So, any comments about the MMH? Of course, the answer is yes. So, the advantage of the MMH is that, of course, by creating the transaction, you can lock your future exchange rate using the spot rate. You can see here, the only way we're going to deal with the foreign exchange rate is trying to buy or sell the foreign currency using our spot rate now. So from that perspective, this is it, nothing more. Okay, so we're going to say that the future foreign exchange rate has nothing to do with us. Rather, we're going something to do with us is the spot rate today. The next comment is about the disadvantage. If the exchange rate subsequently moves in favour of the company, of course the company can benefit nothing from it because it has converted its currency using the spot rate. Okay, so whatever future foreign exchange rate moves, has nothing to do with the company anymore. So we finish off the MMH money market hedge payment and receipt.